Stocks our strategists feel are poised to deliver positive returns are featured now in their top stock picks of the week.
Okay, welcome everyone to today's top stock for April 15th. My name's Andrew Rocco. I'm a stock strategist here at Zacks Investment Research. I also run the Tech Innovators portfolio. So let's jump into today's top stock. And my pick for top stock of the day is going to be ARM Holdings, ticker symbol ARM. And ARM Holdings is a semiconductor and software design company known for creating the architecture for processors used in a wide range of devices, from smartphones to servers. Their designs are energy efficient and scalable, making them crucial for the AI build-out. I'm going to discuss the energy efficiency because that's an important piece of this story a little bit later in the presentation. But AI is a rapidly growing market, as I'm sure a bunch of you know, and ARM's designs are well positioned to benefit from this growth. ARM's business model is unique. It does not manufacture the chips itself. Instead, it licenses its chips to chip makers who then pay ARM a royalty on each chip they sell. ARM's success will depend on its ability to execute on its AI strategy, because that's integral to the business. And I'm going to explain why I think they are executing well on that. So let's jump further into things here. So before we get into the nitty-gritty of the fundamentals and things like that, I just want to point out the strength that we're seeing in ARM. So in case you guys don't know, ARM Holdings, they were a public company a few years ago, and then they got taken private, and then they went public again. And the strength that we're seeing in ARM shares, as you can see on this chart here, it's up 140% versus the S&P 500, which is only up 18%. The strength we're seeing here is abnormal, and I mean abnormal in a positive way. First off, because the IPO market, probably in the last 5 to 10 years, it's been very dry, and IPOs are usually the lifeblood of the market. But what we've seen is a trend in recent years. A lot of IPOs, insiders and early investors, when the company was private, they kind of use it as a means, as a liquidity event to just kind of put their shares on retail investors and cash out of their shares. Instead, with ARM, what we're seeing is even more buying since they've come public. So this has been a rarity in the few years. And it's a subtle sign, in my view, that there's more to this story than just insiders trying to cash out. And again, I'm going to dive into that a bit more later. So Wall Street is becoming more bullish. Here we have some of our Zacks data, which shows us the recent estimate revisions, as well as the consensus estimate trend over the past 60 days. And both of these are trending exactly in the direction that we want to see, meaning Wall Street is becoming much more bullish on ARM Holdings. And what we found here at Zacks is that the consensus estimate trend, the recent revisions of Wall Street analysts, we pool together all these analyst estimates, and if that recent trend is moving higher, that's one of the most bullish things that you can see in a stock, and it's the essence behind the Zacks ranking. And ARM has a strong Zacks rank number 2, which gives it a buy rating. Now let's move on to the industry backdrop, because one of the most important things, even if you're a strong company, if you're in an industry that's not growing, it's not going to do you much good. And of course, AI is one of the strongest industries in the market. In my opinion, it's the strongest by far. And this trend is in the early innings. Actually, in a recent interview, Elon Musk said, AI is the fastest advancing technology I've seen of any kind. And I've seen a lot of technology. And I'm far from a technologist, but I have been on Wall Street for the last 2 decades. And the growth that we're seeing in these AI-related stocks, I've never seen this type of growth as well from an earnings perspective. Just looking at the earnings growth and the future earnings expected growth, you'd probably have to go back to the internet boom. But again, during the internet boom, a lot of these high growth stocks, they weren't yet profitable. What we're seeing with AI, we're seeing that high earnings growth, and these companies are already very profitable. So kind of a perfect storm lining up here. And with the influx of consumer generative AI programs like Google's Bard and OpenAI's ChatGPT, the generative AI market is poised to explode, growing to 1.3 trillion over the next 10 years from a market size of just 40 billion in 2022. So massive growth. This is data from Bloomberg Intelligence, and they're saying that growth could expand at a CAGR, compound annual growth rate, of 42%, driven by training infrastructure in the near term and gradually shifting to devices for large language models. And large language models are like ChatGPT. I think we're just tapping the surface, and a bunch of companies are jumping into the mix here who, ChatGPT is the leader right now, but a bunch of companies are trying to join the fray. And the best part about a company like ARM is they are not trying to mine the gold. Instead, they're trying to sell the picks to the proverbial gold rush, and that gold rush is going to be AI. That's kind of the metaphor I use for these top semiconductor companies. Now, when I'm investing in a stock, one of the main things that's a non-negotiable for me is institutional backing. And ARM has that in spades. So SoftBank Group, the SoftBank Vision Fund, they own 90% of ARM shares, and they are one of the largest capital allocators. They have over 100 billion in capital in this Vision Fund. And I'm a big proponent of sticking with these companies that are backed with institutions, because if poor news comes out, the liquidity within these stocks are going to lessen the blow. So when you have an institutional backed stock, often they use these liquidity events to buy shares on the dip, and there's going to be a little bit less volatility. And in the long run, they have the capital resources to accumulate these shares. And also they have massive research teams. So if SoftBank is putting this much capital behind a company, they're not throwing spaghetti against the wall and hoping that it sticks. They have a deep research team that has done their due diligence. And as retail investors, we simply want to piggyback alongside these smart institutions. Now, in poker, what I look for is a tell, or someone playing poker looks for a tell. One of the best tells in public markets is when a stock should pull back, but it doesn't. And one of the reasons ARM had a reason to pull back was its lockup period. So the lockup period basically bars insiders from selling shares for a couple months until so that they don't just dump all of their shares on the public markets. And what happened with ARM is we had this massive run up in shares, and then the lockup period expired. So you would think that insiders such as SoftBank would take advantage of that and would dump some shares, or at least take some profits. But the stock has held up very well since that lockup period, even though it doubled since its IPO, which was very recent. So again, we're seeing that a lot of smart investors, they have big gains in the stock, but they're not willing to part with shares. And I think that's a big tell for this stock moving forward. Let's jump into the earnings estimate. So we already said that the revision trend is moving higher. And for the current quarter, Zacks consensus estimates predict ARM will grow earnings by a juicy 266%, and they'll achieve triple-digit growth next quarter and 87% annual year-over-year growth. So a lot of companies like ARM Holdings, they have high price to earnings ratios, But what I tell people with a stock that's unconventional, a stock that's growing as fast as ARM is, you have to take the price to earnings ratio with a grain of salt because you don't know what the E is going to be, the denominator in that price to earnings growth. And a company like ARM Holdings, if they're growing at 266% X quarter, they have a good chance to grow into that higher PE ratio. That's the reason there's a premium on these stocks, because their growth is abnormally strong. And I, as an investor, I believe in trying to look for every possible advantage. So I call myself a technical fundamentalist. We've gone over the fundamentals, and that's obviously a driving factor. But one of the best ways to kind of size up your risk reward is simply look at a chart. Like a doctor looks at an X-ray, I like to look at a weekly chart. And what we're seeing in ARM is exactly what we want to see. We see the stock explodes after earnings, massive volume comes in. You see these two green skyscrapers of accumulation. That tells me that institutions are kind of falling over themselves to get into the stock. And what I want to see for a pullback, actually prior to a pullback, is this massive air pocket. That tells me that there's a lot of power within this stock prior to the pullback. So when we look at pullbacks, we want to look at the price action prior to the pullback and then size up the pullback itself. We have this nice uniform pullback to the 10-week moving average. I explained, even though they destroyed their earnings estimates last quarter, investors don't seem to be in a mood to sell. And now we're getting the first tag of the 10-week moving average after this explosive move, which in my experience gives us a nice area to trade against, a nice reward to risk zone. And then you can't talk about AI without talking about Nvidia, which is the leading chip maker. And actually, last quarter, Nvidia revealed their 13F disclosure. Basically, a 13F is an institutional investor disclosure you have to make once you reach a certain size. And actually, ARM Holdings is Nvidia's top stake. So what that tells me is they have the buy-in from other smart money investors, such as Jensen Huang, who runs Nvidia. So it's when Nvidia is looking to take a stake in you, that means you're on the right track as far as I'm concerned, because they're far and away the leader in the AI space. And then finally, we discussed the energy efficiency. So you can see this is a statement from ARM's CEO. He said, by the end of the decade, AI data centers could consume as much as 20 to 25% of US power requirements alone, which is massive. So today it's probably at 4% or less. And really what we're seeing is that, for example, for Google, to run AI, it's about 10 times more as running just your average Google search. So as the inevitable AI build out gains steam, the most energy efficient chips will be needed. And that's exactly what ARM Holdings is known for. So again, ARM Holdings, they make the energy efficient chips. We're going to need those moving forward. They have massive earnings. Wall Street's getting more bullish on the stock. The technicals are there. Institutional investors are backing the stock. So for all those reasons, I believe ARM Holdings will be much higher 6 to 12 months from now. Thank you so much for watching. That wraps up my part of the top stock for April 15th. I'm going to pass it to my colleague, Ben, now. Thank you very much.
Hello, everybody. Ben Rains here today for top stock picks at Zacks. Today I'm looking at AppLovin Corporation, which trades in ticker APP. AppLovin is an app monetization company that skyrocketed nearly 350% in the last 12 months. This blows away the Zacks tech sector, which is up 40%. AppLovin has also crushed Nvidia, Meta, and many others during that stretch, yet it still trades about 33% below its all-time highs, and its valuation levels are improving as its earning outlook continues to soar. So Wall Street's falling for the stock because its new AI-enhanced features are boosting return on investments for App's clients, leading to booming sales and earnings growth for AppLovin. AppLovin designs tools to help developers improve marketing, revenue generation, and boost profitable expansion. It helps companies and app developers acquire and keep their ideal users, increase value across the customer's lifecycle, measure marketing and reach, and much more. In its new AI and machine learning are generating impressive results for the clients in mobile gaming and beyond. The company's also benefiting from a shift to real-time bidding overall, plus digital advertising in general is booming back after that big slowdown in 2022. So that really is helping AppLovin grow both now and going forward. So now let's go over to Zacks.com and some ZRS systems to take a look at some other fundamentals for AppLovin. So we can take a look, we'll go over to Zacks.com first and take a look at some of the company's growth outlook. So we can see right here that we're calling for 23% revenue growth this year. This comes on top of flat revenue growth, flat revenue growth in 2022, and then 17% growth in 2023. And that came on top of 93% growth in 2021. So we're calling for solid growth, 23%, and then another 10% growth in 2025 to get all the way up to about 4.5 billion. And this is up from 2020 when they did 1.5 billion. So a massive jump over the last several years for AppLovin. And then on the bottom line, we're calling for 152% bottom line expansion from 98 cents per share all the way up to $2.47 per share. And then another 22% adjusted earnings growth next year. And then if we go over and take a look at some of its estimate revisions, we can see that the company's earnings outlook has surged since its last report. We can see it's up 70% for its first quarter of 2024, 90% for Q2. Overall, it's up 58% for fiscal 2024, and then it's 74% for 2025. So we can see right here as well, just those revisions going straight up more recently and then trending higher over the last year plus as well. So a great outlook for AppLovin. And now we can go over and take a look at some of its price performance. So we can see the stock is up 350% over the last year. That easily tops the tech sector, which is up 42%. And then we can take a look over the longer period. We can see, so over the last 3 years, the stock is up about 21%, roughly matching tech. But if we see it peaked back in November of 2021, and it's yet to return to that level. So it's still trading 33% below those all-time highs. And the stock went public in April of 2021. So it had a nice run before then. The market in tech stocks peaked in November of 2021, and it still has not returned to those levels. So that's a good place for people to buy into a stock that's already jumped so much, but still has plenty of room to go before it returns to its all-time highs. And then we can take a look at its technical levels. So we'll go to a year stretch here. So you can see it's trying to find some buyers at its 21-day moving average. The market's kind of trying to use that 21-day level as its support line as well. So we can see it's now a little bit closer to neutral RSI levels as well. So if it falls back, say, below the 21-day to the 50-day or maybe even the 200-day, those could be some nice, enticing buying opportunities for investors looking into AppLovin. It'll go over to some valuation levels as well. And we can see as this chart doesn't want to pull up for me, put this figure down. Little stretch on my screen here at the moment. So we can see it's trading. We'll go to a 2-year chart. We can see that AppLovin is trading at 28.8 times forward 12-month earnings, which is down well from where it was several years ago. It traded at a high of at one point 101 times over the last 2 years, and then way above that when it first went public. So we can see that it's gone down in a really impressive way, even as the stock is trending back up higher as well. So before we get rid of this Zacks screen and I kick it over to my colleague, we're going to just take once again a look that it's a Zacks rank number 1 strong buy stock. It is down today as I'm recording this on Monday. So as I said, it could be try to get to that 21-day moving average in the near term. But if it pulls back to, say, the 50-day or a longer term moving average like the 200-day, definitely a stock to consider for investors here. And if it does come in at some of those longer term moving average, even a more enticing opportunity, and its valuation levels are really improving with that upward earnings revisions trends we've seen. So overall, AppLovin helps its clients thrive in a world where countless companies are fighting just for visibility in that app world, download, screen time, profitable success, in a world that's full of smartphone addicts and really app-obsessed world. So that does it for me in this episode of Top Stock Picks. Make sure to check out our Zacks.com/promo page for a look at some of our services, portfolios, and more.